Why cannot we print unlimited money? If I had a machine that could print unlimited 500 rupees notes, would I become the richest person in India? Let us find out. But before beginning, let us understand few concepts to gain conceptual clarity. Did you know that money and currency are not the same? They are different. Money is anything that people generally accept as a medium of exchange to buy goods and services. It also serves as a store of value, which means you can save it for later. Or as an account, it means it measures price. Or as a medium of exchange, it is used to buy goods, buy and sell. Example, cash, your bank deposits, money in your digital bank accounts. Then, what is currency? Actually, currency is the physical form of money. Money, such as 10 rupee notes, 100 rupees notes, 500 rupee notes, or 1 rupee coin, 5 rupee coins, these all accounts for currency. Or we can say that all currency is money, but not all money is currency. Next, we have is purchasing power. It is the real world value of money, measured by quantity of goods and services a single unit of currency can buy. Next, we have is inflation. When prices rise, your money's purchasing power drops, meaning a single unit of currency buys you less than it did previously. Or when demands for goods and services increases as compared to the available supply, which causes sellers to raise prices. Hence, the term inflation. Next, we have is hyperinflation. It is an extremely rapid and uncontrolled surge in prices. Basically, it rapidly wipes out the purchasing power of a currency, causing citizens to quickly spend money before it loses value or abandon the currency entirely. So, how does it happen? It happens when a country's government begins printing money to pay off for its spending. Instead of tightening the money supply, what the government does, the government keeps printing more and more money. So, what happens is hyperinflation, and basically, it is a price rise of goods and services more than 50% in a single month. As the government increases the money supply, prices rise as in regular inflation. But over here, the price rises just skyrocket. In a way, it gets skyrocketed. Next, we have is repo rate. Basically, it is the interest rate at which RBI lends money to commercial banks for a short period. For India, the RBI has set repo rate at this present moment, this is July 2026, 5.50%. So what happens if RBI increases repo rate, the banks increases their interest rates. So the borrowers who take loans, they borrow less, and due to which spending decreases and inflation comes down. Next we have is benchmark interest rate. What is this? This is basically a baseline reference rate used by financial institutions to price loans in mortgages and bonds, typically set by central banks. For India, the benchmark interest rate is repo rate, which is set by Reserve Bank of India. Next, we have is mortgage. What are mortgages? Basically, it is a legal agreement where a borrower pledges a property as a security for a loan without handing over ownership. If the borrower is unable to repay the debt, the lender holds the right to sell the property through a court order to recover the dues. At last, we have to understand is monetary policy. Monetary policy is basically the strategies and actions a central bank uses to manage the money supply and influence the economic growth. Why can't we print unlimited money? So in India, currency notes are issued by the Reserve Bank of India under rules set by law, with some denominations issued under specific government provisions. But just because money can be printed does not mean it should be printed without limits. Money only has value when people trust that it can buy goods and services. So what gives money its value? Think of money as a ticket that lets you buy things. Now imagine there are only 100 pizzas in a city. Today, people together have 10,000 rupees, so each pizza might cost 100 rupees. Now imagine the government prints another 10,000 rupees, but there are still only 100 pizzas. So basically, the supply is the same. People now have more money, but the number of pizzas has not changed. The result? The price of each pizza goes up. This is called inflation because the demand has increased, right? Inflation means the prices of goods and services increase over time. When too much money chases too few goods, sellers raise prices because demand is higher than supply. If salaries do not increase at the same speed, people's purchasing power falls. So printing more money does not magically create more food, houses, or cars. It mostly makes existing things more and more expensive. History gives us some powerful examples, like what happened in Zimbabwe during 2000s, in Germany, Weimar Republic during the early 1920s. Governments printed enormous amounts of money to deal with economic problems. The result was hyperinflation. Prices rose so rapidly that money lost much of its value. People needed huge amounts of cash to buy everyday items. These examples show why governments and central banks try to avoid excessive money printing. That does not mean printing money is always bad. As the economy grows and more goods and services are produced, the country may need more money in circulation. Central banks carefully manage the money supply to support economic activity while trying to keep inflation under control. The goal is balance, not too little money and not too much. So a country's wealth is not measured by how much money it prints, it is measured by what it produces. Its food, industries, technology, services, and skills of its people. Printing unlimited money does not create real wealth. That is the reason we do not print unlimited money. It merely reduces the value of the money that people already have. As you have already know, that once a thing comes in excess, it basically loses its value.